All right, let's talk Rapid Micro Biosystems, ticker RPID. They just dropped their Q3 earnings, and wow, it was a pretty big one. We're going to dig right into what went down and, more importantly, what it all means for the stock.
And boy, did the market like what it heard. The stock jumped almost 13% right after the announcement. So you got to ask, what's driving that? Was it just a simple revenue beat, or is there something, a little deeper going on here? Let's get into it.
Okay, so here's the game plan for today. We'll start with the headline numbers for Q3, then we'll get to the real story behind that beat. From there, we'll look at the big picture strategy, put the stock's reaction in context, and wrap it all up with our thesis on what's next.
All right, first up, the Q3 results. Now, if you just glance at the numbers, they look pretty solid, pretty straightforward. But when you dig in just a little bit, you start to see this really critical shift happening inside the business.
So, here's the scorecard. Revenue came in at $7.8 million, which was a nice little beat over the $7.6 million Wall Street was looking for. Now, the loss per share was negative 26 cents, exactly what was expected. So no surprises on the bottom line, but that tiny beat on revenue, that was actually a clue that there was a much bigger story brewing.
And here's where it gets really interesting. It's not just about the total revenue, it's about the type of revenue. The recurring revenue, the steady, predictable money from consumables and service contracts, it shot up 32% year over year. That's huge. It shows the business model is shifting away from just selling a box one time to creating a stable, ongoing income stream. And let me tell you, investors absolutely love to see that.
Okay, so that recurring revenue growth is great, a really strong signal. But that's not what lit a fire under the stock. Nope. The real reason for that big jump was one single piece of news, an announcement that basically rewrote the whole story for this company. And the CEO, Rob Spignesi, he put it perfectly. They landed the biggest multi-system order in the company's history. And he was clear, this isn't just about the money. This is proof, validation that their platform can handle the toughest jobs for the biggest biopharma companies on the planet.
So why is this one deal such a game changer? Well, a couple of things. First, it came from a customer they already had, one of the top 20 global biopharma players. That's a massive vote of confidence. Second, this isn't just for one lag. They're rolling these systems out across North America, Europe, and Asia. That proves this thing can scale. And the kicker? It's going to start adding to the top line right away in Q4 and into next year. So big, in fact, they had to raise their guidance for the full year.
A deal like this doesn't just fall out of the sky. It's not luck. It's the payoff from a very specific three-part plan that management has been putting in place to essentially take risk off the table and pave the way for this exact kind of growth. So, what are these three pillars? First up, they leveraged their sales channel. They teamed up with Mercks MilliporeSigma, which gives them a huge footprint they couldn't get on their own. Second, they shored up the balance sheet, securing a $45 million loan to make sure they have the cash to fund this growth. And third, well, this giant order is the demand proof, the ultimate validation. See how it all fits together? They basically went down the list of investor worries, sales, cash, demand, and checked every single box.
Okay, so we've got the fundamentals down. Now let's pull back and look at the big picture, the stock's performance. Because that almost 13% pop we saw, yeah, that's just the tip of the iceberg.
I mean, look at this. The momentum is just off the charts. Over the past year, RPID is up almost 300%. To put that into perspective, it's not just beating the S&P 500 or the biotech ETF. It's absolutely crushing them. This is what it looks like when a company lays out a plan, executes on it, and the market finally wakes up and says, whoa, okay, we see you.
All right, that brings us to the big finale, the next call. We've looked at the quarter, we've looked at the strategy, we've looked at the stock's run. So what does it all mean going forward? Let's synthesize all of this into a clear thesis.
So the whole debate around this stock really boils down to this. On one hand, you've got the bulls. They're looking at that accelerating recurring revenue, the huge validation from that record order, and the fact that management has de-risked the story. It's a great setup. But then you have the bears, and they're pointing out, hey, this company is still losing money. And the really big one, their gross margin is only 9%. Just 9. That means for every dollar in sales, they're only keeping 9 cents, which makes getting to actual sustainable profitability a really tough climb.
Okay, so here's our take for the next call. For Q4, we fully expect them to meet or even beat that new, higher guidance of at least $33 million. That big order should make sure of that. The stock's momentum, we think it continues for a bit. But the story is going to shift. As we head into 2026, it won't be about revenue anymore.
It'll be all about gross margins. Can they prove this model is profitable? That's the next big test. But for right now, given the incredible execution and the clear catalysts in front of them, our rating is outperform.
And of course, we have to say it, this is for informational purposes only. It is not financial advice.